like we know that financial markets are of two types, which is the primary markets and the secondary markets. Primary markets are those wherein the securities are traded for the very first time in the market. They have been issued in the market for the very first time, like the IPOs or the FPOs, right issues, NCDs, etc. They are types of the primary market activities. Whereas secondary markets are those where the existing securities are traded in the market. So the transaction between the primary market is normally between the investors and the companies, where these companies or corporates issue these securities for the very first time in the markets. And in the secondary markets, as we can see, that since the existing securities available in the market are ready for trading, the transaction between the secondary markets are between investors and investors. Now again, secondary markets can be subdivided into two categories, which is the debt markets and the equity markets. Now we all know that the different asset class which is there in the financial markets are equities, currencies, bonds, etc. And derivative is something which is deriving its value from the underlying assets, derivative securities. So these underlying securities are equity, currency and bonds. Equity, as we all know, that what are equity derivatives and currency derivatives, but there is much less knowledge of debt markets as it is not very common in India. So in this webinar, we would be discussing about the debt markets in India as well as the derivatives traded on debt. So let us start our discussion with the fixed income securities. Now the fixed income securities can be subdivided into two categories, which is the money markets and the other one is the bond market. Money markets are those wherein these instruments with very high liquidity and short-term maturities are traded. Whereas debt markets are those which have a longer-term maturity and the securities are normally issued by the central or the state government. Now, fixed income securities can be classified into many categories based on cash flows, tenures, and issuer interest rate type, credit quality type, etc. Let us have a look at the fixed income securities based on the cash flow patterns. Based on the cash flow, by cash flow we mean that the amount which the receiver or the lender of the money is receiving or paying in terms of interest and principal. Based on the cash flow, fixed income securities can be classified into three subcategories, that is the coupon instruments, annuity and zero coupon instruments. Let us have a look at each of them in detail. Coming to coupon instrument. Coupon instrument pays a periodic fixed amount which is called the coupon. Basically, it is referred as the interest rate. It represents the interest rate and the final principal amount is paid on the maturity. Coming to annuity. Annuity are those which pays coupon and a part of principal in such a manner that the cash flows are equal in size and equally spread out in time. For example, whenever we take a car loan or an EMI or a housing loan, these are all examples of annuity wherein at periodic intervals a part of principal payment and a part of coupon interest payment is paid at each end of period. Then comes the zero coupon instrument. which does not pay any amount before the maturity date. The interest is accumulated and compounded and paid along with the principal at the maturity as a single bullet payment. Let us understand this with the help of this example. Like in this slide, we can see this diagram. There are three different categories of bonds. One pays the coupon interest, one is annuity type, and one is a zero coupon bond. All of them have an implied interest rate of 5% per year, and it has a maturity of 3 years. The redemption value of these bonds are rupees 100. Now, as we can see, that 100 rupees has been lended to the borrower today on time T. And if it is a coupon instrument, a periodic amount of rupees 5 at the end of each year is received by the lender. That is 5 rupees here, 5 rupees here. And then at the end of 3 years, when the coupon instrument matures, the lender will receive a 5 rupees as a coupon interest payment, and his principal, that initial principal which he had received, that is 100 rupees back. If it was an annuity, the investor would be getting 36.72 at the end of every year, which includes for the first year 5 rupees as the interest payment and 31.72 as the part of a principal. Coming to the end of second year, again the principal amount is 33.31 rupee, and the interest payment is approximately 3.41. As we can see, when we go down the number line and the time frame, the interest amount keeps on decreasing and the principal amount keeps on increasing when we speak of an annuity. The reason behind this, that the interest amount keeps on decreasing, because as we are repaying a part of the principal every year, so the next year when you are getting the interest amount, it is on a lesser amount of principal. Hence, we can see that every year the principal amount increases and the coupon interest amount decreases with each subsequent year. Now, as we can see here, when we talk of zero coupon bonds, they are normally issued at a discount. So the amount which is spent today by the investor is 86.38, and after 3 years he gets a bullet repayment of rupees 100, wherein 86.38 is the principal part and 13.62 is the compound interest for the 3 years which he has received at the end of 3 years. I hope I am clear in explaining what we mean by fixed income securities based on different cash flow patterns. Let us move on to the next category of fixed income securities based on tenure. These can be classified again into money markets and bond markets based on tenure. By tenure, we mean the time period. As I had earlier mentioned, that money markets are those fixed income securities which have a maturity less than 1 year, and they are very liquid instruments. Large financial institutions, dealers, government participate and meet out their short-term cash needs through these money market instruments. Coming to the bond market securities are those which have a maturity of more than 1 year. They are normally issued by the central or the state government, municipal corporations, etc.